$725 billion. I mean, just let that number sink in for a second. That is the projected 2026 capital expenditure of just the five largest cloud and AI infrastructure giants. We are literally talking about almost $750 billion, all being deployed in a single solitary year into data centers, custom silicon, and power grids. It's just a staggering amount of money. It's actually almost double what we saw just last year. And, it completely sets the stage for what is undeniably the most high-stakes financial sprint in modern corporate history.
Welcome to this explainer. Look, if you're trying to figure out where the real money is actually being made in artificial intelligence right now, and where it's quite frankly probably being set on fire, you are in the exact right place. Today we're taking a really structured journey into the economics, the execution, and most importantly, the stark reality of AI returns on investment. We're going to cut entirely through the media hype to look purely at the numbers and the totally ruthless market dynamics driving them.
Okay, so let's dive right into this. Here is our agenda for today. 1. The AI sorting mechanism. 2. The hyperscaler spending spree. 3. Monetization and execution. 4. The software cannibalization threat. 5. The ROI reality check. And 6. Value in the adopters.
Section 1. The AI sorting mechanism, separating the reality from the hype.
Right now, the stock market is acting as a ruthless, highly efficient sorting mechanism. It's aggressively rewarding companies that have clear, near-term AI revenue growth while heavily punishing anyone who's just running on pure enthusiasm. To really get this dynamic, think of the product lifecycle of AI adoption like a massive financial waterfall. Right at the top, catching the absolute heaviest flow, we have stage 1, the infrastructure providers. These are your chip makers and hardware guys. Here, the return on investment is the fastest and, well, the most visible. When hyperscalers commit massive capital, these stage 1 companies see it hit their order books almost instantly. Then, as the water flows down, stage 2 brings us to the AI native platforms. Think Alphabet or Meta, companies that have the sheer scale to both build and internally deploy massive AI models. Further down is stage 3, the AI integrators. These are the legacy enterprise software names trying to embed AI into their existing products. And finally, sitting at the bottom pool, we have stage 4, the enterprise adopters. Think retail chains, hospitality groups, or global consulting firms leveraging AI to streamline everyday operations. But the absolutely crucial thing to remember here is this. As you move from stage 1 all the way down to stage 4, the timeline for a visible, undeniable financial payoff gets way longer and much, much harder to prove to impatient investors.
And because absolutely everyone wants that stage 1 instant payoff, a massive fear of missing out, just overwhelming FOMO, is basically taking over the entire sector. Today, very few companies are making perfectly calculated ROI-based decisions on their AI spending. They're throwing money at it simply because they are terrified of falling behind the competition. Just look at the staggering contrast between today and the dot-com bubble. During the absolute peak of the internet boom, tech's contribution to US GDP growth barely hit 60%. And honestly, back then, that felt like a total revolution. But today, over the 4 quarters ending in March 2026, tech-related investments are estimated to drive an unbelievable 90% of US GDP growth. So the sheer scale of this rushed, sort of haphazard spending is vastly eclipsing the entire internet boom.
Section 2. The hyperscaler spending spree. Following the massive capital deployments.
So the cloud infrastructure providers, we call them the hyperscalers, are in an absolute arms race. You've got Amazon guiding for an astronomical $200 billion in 2026 projected CapEx. Microsoft is right behind them at $190 billion, and Google is projecting somewhere around $175 billion. To really put this into perspective for you, these individual companies are effectively taking the entire market capitalization of a major Fortune 500 company and just deploying it into concrete, data centers, and servers, all in a single calendar year. The sheer scale of capital destruction or creation happening right now is completely unprecedented.
Let's zoom in on Microsoft for a second to understand exactly why they're spending quite this much. That $190 billion budget, it's a massive 61% jump from their 2025 spend. How do you possibly justify a leap like that to your investors? Well, their Azure AI business did recently hit a $37 billion annual run rate, and it's growing at a blistering 123% year over year. But here's the real kicker. OpenAI has separately contracted to purchase an incremental $250 billion of Azure services. So Microsoft's unfulfilled demand backlog is sitting near $80 billion simply because of the sheer electricity required. Seriously, power availability, actually securing the gigawatts from the power grid, not even just getting the chips, is heavily bottlenecking their ability to build data centers fast enough to meet this massive, locked-in commitment. Meanwhile, over at Amazon, this historic spending sprint is creating an incredible amount of financial tension. Amazon's trailing 12-month free cash flow, and remember, free cash flow is the actual tangible cash a company has left over after paying for its operations and capital investments, has practically evaporated. I mean, it's collapsed by 95%, dropping all the way down to just $1.2 billion. Why? Well, because of that mammoth $200 billion AI capex plan just draining the coffers. The market is actually penalizing Amazon right now, essentially demanding a discount to own their stock because of this massive cash conversion risk. If Amazon's cloud division, AWS, doesn't maintain an incredibly aggressive growth rate to justify all this spend, this $200 billion layout could easily become the most expensive mistake in corporate history.
Section 3. Monetization and Execution. The Stage 1 Infrastructure Winners.
Remember stage 1 of the AI lifecycle from earlier? The infrastructure providers sitting at the very top of that waterfall? Well, their primary KPIs right now define them as the clear, immediate winners of this boom. They are absolutely printing money today because every single dollar of that hyperscaler capital expenditure we just talked about is basically their direct revenue. NVIDIA has been selling virtually every GPU it could possibly produce, which drove their data center revenue up an astounding 142% year over year. Broadcom saw its AI, silicon, and networking backlog climb to a massive $73 billion as companies just desperately queue up for custom chips. And Micron saw its high bandwidth memory revenue grow 5 times over the previous year. For these specific companies, the ROI story isn't some distant future promise. It is straightforward, undeniable demand driving massive volumes and immense pricing power right here, right now.
Section 4. The software cannibalization threat. The Stage 3 integrator laggards.
Now, let's move down to Stage 3 and see how this builds a drastically different picture. Enterprise software companies are aggressively integrating AI into their platforms, but the market is heavily punishing them for it. The core reason? A deeply rooted fear of software cannibalization. Investors are frankly terrified that new AI agents, which are getting increasingly capable of handling complex, multi-step tasks all on their own, will actually automate the very workflows these companies currently sell expensive software to manage. For a company like Adobe, the fears that their Firefly generative AI might cannibalize their existing creative tools before it meaningfully monetizes. And for Workday, the irony is thick. If AI successfully automates complex HR and finance workflows, it effectively reduces the required human seat counts and eliminates the very complexity that their entire subscription business model depends on. In a weird way, these companies are essentially building the tools that could make their own legacy products obsolete, totally commoditizing parts of their own existing businesses.
Section 5. The ROI reality check. The daunting math of the AI bubble. So, the ultimate question for the entire market, the massive elephant in the room here, is this. Can the hyperscalers actually generate enough end-user revenue to justify spending $750 billion? Right now, we're seeing this bizarre dueling reality on the ground for businesses trying to adopt this tech. On one hand, the cost of an individual AI token, and you can think of a token as a little digital syllable of computing power, has plummeted by over 99% since the GPT-3 era. So computers getting cheaper, right? But on the exact same hand, average enterprise AI bills have actually tripled. Why? Because the newest highly capable AI agents can multiply token usage by 50 to 500 times just to complete a single task. The overarching costs for end users are rising rapidly, and that's actually leading some major corporations to pump the brakes, scale back their deployments, and actively look for cheaper open-source alternatives.
And that brings us to the absolute most daunting math of this entire explainer. To earn just a baseline 10% return on this historic capital investment, and by the way, that is assuming zero operating costs, just the pure capital return, the major hyperscalers would collectively need to generate between $2 and $5 trillion of incremental annual revenue. Let me just repeat that. $2 to $5 trillion of brand new incremental revenue. Let that sink in for a moment. Their current combined total revenue across all their entire businesses today is only about $1.5 trillion a year. So, if this financial analysis holds true, eventually the laws of gravity dictate one of two things must happen. Either this massive spending spree must eventually fade, or prices across the entire AI ecosystem will need to rise drastically to cover that monumental multi-trillion-dollar gap.
Section 6. Value in the adopters. Finding opportunity in everything else. So, the crucial point is, where in the world do you look for value if the current AI leaders are priced for absolute mathematical perfection? You look at Stage 4, the enterprise adopters. For the average business out there, over 90% of the real tangible AI opportunity isn't in creating flashy new AI products to sell, it's entirely on the cost side of the equation. It is vastly easier to measure your return on investment when AI directly drives internal productivity and expands your profit margins. Furthermore, many of these incredibly solid businesses are currently being completely ignored or even priced by the market as AI losers, which actually means they offer a fantastic margin of safety for an investor. Take a company like FTI Consultant, a massive crisis management firm. If they adopt AI internally to automate thousands of hours of tedious legal document review, they suddenly free up their highly paid human consultants to focus strictly on high-level strategy and client billing. They become vastly more efficient and their margins expand. It's a brilliant heads we win, tails we have a massive margin of safety scenario.
Which leaves us with this final, really pressing thought. We are witnessing an infrastructure build-out right now that is genuinely unlike anything in modern financial history, driven largely by an intense, visceral fear of falling behind. Will this bold hyperscaler execution actually unlock trillions of dollars in brand new economic value and unprecedented returns? Or will that daunting, inescapable math eventually catch up, turning this $725 billion sprint into the most outrageously expensive cautionary tale in corporate history? The market is aggressively laying its bets right now. The question is, where are you laying yours? Thank you so much for joining me for this explainer, and remember to always keep questioning the numbers.